my last episode, I mentioned that central banks are preparing to take action soon. Hey there, I'm Jun, a researcher from Dxpert. If you missed the last episode, I suggest you to head back and watch the previous video. Now, let's get started with the outlook of global rates moving forward. Based on forecasts from various economists globally, the GDP-weighted global central bank rate is expected to drop to 6.2% by the end of the year, down from a peak of 7.2% in the first quarter of 2024. But this would still be twice as high as levels seen before the pandemic. Further easing is anticipated to lower it to 4.8% in 2025, indicating a tighter policy stance compared to any time in the decade following the global financial crisis. For advanced economies, the rate may decrease to 3.7% this year and 2.8% next year, down from 4.5% in the first quarter of 2024. In emerging markets, excluding China, rates are expected to fall more rapidly from higher levels, dropping to 12.3% in the fourth quarter of 2024 and 8.9% in the fourth quarter of 2025, compared to the 14% in the first quarter of 2024. Fed's official appears confident that inflation will decrease due to favorable supply-side factors, and Chair Powell has shown a dovish bias. However, with inflation remaining stubbornly high at the start of the year, we believe the Fed's future action are now binary. If national unemployment rises to 4.5% as anticipated, then expect the Fed to cut rates by a total of 50 basis points this year, less than our previous estimate of 100 basis points. Now, if the unemployment rate remains close to the current 3.8%, then they might not cut rates at all. Meanwhile, Anna Wong from Bloomberg highlighted that California's unemployment rate is hovering around 5.3%, indicating a significant slowdown in the job market. This level often precedes a recession. Since California is the largest GDP contributor in the country, trouble in this state could have ripple effects on other states. Although Powell expects inflation to continue declining, he is less confident about this than before. Nevertheless, as discussed in the previous video, various data suggest a gradual decrease in inflation is likely, which could lead to a potential drop in rates. The comparison chart indicates that while the magnitude of rate cuts may be reduced, but cuts are still expected eventually. Since the favorable CPI released a few days ago, I think it's quite solid that we will see the first rate cut by the Fed to happen in September. Turning to Europe, the ECB president stated last month that unless there is a significant shock, the central bank is approaching a point where it needs to ease its restrictive monetary policy. The ECB is expected to soon lower interest rates, with headline inflation and underlying price increases slowing down and wage growth also decelerating. We anticipate the ECB will cut rates by 25 basis points in June. As the Harmonized Index of Consumer Price or HICP continues to fall, it is on track to reach the 2% target by the third quarter of 2024. Although the core inflation figure will still be higher, the diminishing threat to inflation expectations reduces the need for such restrictive rates. We foresee additional cuts in September and December, and we don't believe the Fed's timing will affect this schedule. Lagarde emphasized that the ECB's decisions are not Fed-dependent. Meanwhile, for the UK, this early 2024 GDP surge won't be repeated, and growth to moderate. The UK economy experienced a significant rebound in the first quarter of 2024, with output rising by 0.6%. This growth more than compensated for the 0.4% GDP decline in the later half of 2023. Forward-looking surveys suggest that activity continued to recover in the second quarter without recession in sight for the moment. CPI inflation fell to 3.2% in March, indicating that the UK's inflation issues might not be significantly different from those of other countries. Core inflation also decreased to 4.2% from 4.5%, down from a peak of 7.1% in May 2023. Services inflation, closely linked to the domestic economy, is running at 6%. Still, nearly double its 2000 to 2019 average. The Bank of England's stance has notably shifted since early 2024. They dropped their tightening bias in February and suggested in March that they could ease policy while still maintaining a restrictive stance. We anticipate the first rate cut in August, followed by another in November, with a third cut expected next year. With this timeline in mind, Fed cutting in September, ECB in June, and BOE in August. There are plenty of opportunities to trade these currencies. Generally, a cut in interest rate weakens the respective currency. The staggered timing of these cuts creates potential to profit from the resulting uneven markets movement. Thanks for joining me today. I hope you have gained insights from today's video. Everything I've shared are information that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risks. If you find this video helpful for your research, please subscribe, share, and like it. Quickly access to all our channels by scanning the QR code. Take care, and I'll see you in the next episode.